Whether it's me or somebody else online, if you hear somebody talk about total cost of risk and you're just like, what are they talking about? That's what I'm here to answer for you today. Now, total cost of risk is something that is really central to how we approach our clients, but it's really not a good way to describe what we do. Now, most companies, they look at their insurance premiums because that's what they've been trained to look at. And that's the easiest thing to look at. It's a line item on the P&L statement. You can define exactly what it is to your accountant. Easy peasy. Now, unfortunately, that's not the end of the story. There's really a much bigger picture to this at the end of the day. And that's what total cost of risk really is. It's the bigger picture. So there are three buckets you should really consider when it comes to total cost of risk. First of all is prevent and protect. So the story doesn't start with a claim. It starts on what was done to prevent the claim from happening in the first place. And that's where the protection piece comes in. When we work with a company, we are looking at what's happened in the past, what we can do to prevent that from happening again, and really identify some of the high risk areas for that particular company to make sure that those things don't happen. However, if they do happen, that's where the protection piece comes in. We want to make sure that the insurance coverage is in place and covers what we intended it to cover. Second of all is the hit. So, unfortunately, things do happen. Claims happen. And so, what does the out of pocket look like? Is there any overtime that's needed in order to compensate for an injured employee, for example? Or maybe there's a loss of income because of a claim at the business. What is the out of pocket expense in the event of a claim? And then thirdly is really the ripple effect. What happens moving forward? Because a claim is not a claim and then it's over. It has implications down the road. Maybe in future insurance premiums. Sometimes it's even in things like you lose a job or you have to pay more overtime and employees get disgruntled and loss of morale. So there are so many things that can happen as a result of those claims down the road that we need to pay attention to. So those are the three buckets. And you can start to see why insurance is just a very small piece of the puzzle. So I want to tell you a little bit of a story about a company that we were talking to about 12 months ago, and it was us and another broker that they were talking to. They decided to go with the other broker because they were about 10% less. So they saved about $15,000. Now, they came back to us again this year and asked if they could work with us. And we started to uncover what happened over the past 12 months. Unfortunately, that $15,000 savings was wiped out and some. The reason being is because they had a few claims, things weren't put in place, and because of accrued overtime that they had to pay, because of loss of jobs that they had, so the loss of revenue, and because of future insurance increases as a result of those claims, that year was about $250,000 that they are going to have to come up with. And so it was actually a significant difference at the end of the day. And that's where the difference between insurance premium and total cost of risk really comes into play. Is this is a focus on the profitability of your company, not in the here and now, but over the next 6, 12 months and on. So if you need help analyzing your total cost of risk and you would like us to help you with that, feel free to reach out. We're happy to help.